Hello everyone, welcome to September's market review. The overview, as always, will be covered with three main points. First of all, September has been a positive month, and this is the first positive month in 5 years, thanks to a Fed rate cut and an announcement of China's stimulus. In the second point, as we enter the fourth quarter, we look at the overall performance in Q3 for dimensional equity funds, which shows that small and value has been outperforming, hence dimensional equity funds is outperforming the index. The final point, we have a key takeaway, which is that for long-term investors, they have a premium over the risk-free rate, and hence it is important to stay invested. Without further ado, let's go into September's performance. As mentioned in the first point, September 2024 is the first positive performance in 5 years. And you can see that in this chart, which shows the September performance from 2019 to 2024. And since 2020, all the way to 2023, we are seeing a negative return. And now in September 2024, we have both the MSCI All Country World, MSCI World IMI, and MSCI Emerging Markets IMI all showed positive returns. What is driving the September's performance? Well, first of all, the Fed did a huge rate cut of a 50 basis point in September, and this drove the market up. And the first to benefit would be the US S&P 500 index, which rose at 2.14%, and the MSCI World IMI index, which reflects 99% of the developed market, rose by 1.84%. Now, of course, when the Fed does do rate cuts, yields would fall. And what we are seeing right now is the Bloomberg Global Aggregate Index rose by 1.16%, because when yield fell, price would rise for bonds. How about the emerging market? Now, as you can see in this chart, the emerging market rose by 6.23%, outperforming the developed market counterpart by more than 4%. Why is this so? Because the China government announced a jumbo stimulus, which the emerging market reacted favorably. Now, overall, the MSCI All Country World IMI, which reflects both the 99% of the emerging market and developed market, rose by 2.3%. Going into quarter 3 performance, across the board, you can see that the MSCI All Country World IMI, Emerging Market IMI, S&P 500 Index, all were positive. And also, the Bloomberg Global Aggregate Bond Index also went up by more than 4%. But underneath this positive performance in Q3, there were a lot of volatility. For example, at the start of August, there was a carry trade unwind that caused equities to have a sharp fall. But subsequently, cooling inflation in US actually led to a higher possibility of a rate cut in September, which in hindsight, we know that the central bank has actually cut by 50 basis points. Additionally, in quarter 3, we are also seeing that value is outperforming growth, as well as small outperforming large. As you can see from this chart, that the MSCI World Value, which reflects the value stocks in MSCI World, against versus the MSCI World Growth, has been outperforming by more than 6%. Now, on the other hand, comparing small MSCI World Small Cap versus the MSCI World Large, it has outperformed by more than 3%. This means that the dimensional equity funds, which has a tilt towards value and small, has been outperforming their market indexes. Notably, if you look at the dimensional global targeted value, it has went up by 8.21% in Q3. The lesson from quarter 3 is to stay invested and ride through the volatility to capture the risk premium. Now, if we compare the global core equity versus the risk-free rate, which we use as using the 3-month US Treasury Bill as the risk-free rate, we can see that the premium of the global core equity Q3 has been 5.66%, year to date 12.18%. But it is not that there is no volatility. As you can see, if we go back 3 years, the premium have decreased from the year to date 12.18% to 4.47%. Now, however, if you stay invested over the long run, your return, for example, for 10 years, over the 3 years US Treasury Bill, the premium is 7.55%. The important lesson is that the market offers a premium over a long time period. Now next, let's also take a look at the importance of diversification. Now in this chart, you can see the index performance from comparing two periods, 2001 to 2010 as the first period, and 2010 to 2020 as the second period. In the first comparison on the left, we have the MSCI World Index versus the MSCI Emerging Market. Now imagine that you are invested in 2001 to 2010 in the MSCI World Index, and your return for that decade is only 2.3% per annum. Now, if you were to decide that the return is too low, looking at the performance of the MSCI Emerging Market in 2001 to 2010 as about 15.9%, you will be tempted to switch your investment in 2010 to 2020 to the MSCI Emerging Market Index. And you will see a return being only 3.6%, while the MSCI World in 2010 to 2020 has been 9.9%. Going across to the remaining charts, you can see that regardless of investing in different factors of equities, like the small cap or the value, or in different asset classes, the MSCI World Equity Index or the Bloomberg Global Aggregate Bond Index, you can see that they provide the same lessons. It is extremely difficult to know and predict which asset classes or which factor will be doing well, but we focus on the empirical evidence, which is that it is important to stay invested and diversified to capture the premium across the asset classes and the factors themselves. I'll be handing over to Alvin, my colleague, who will be talking more about the importance of diversification and the importance of time in the market. Thank you.
Thank you, Choon Siong, for the market update. Hi clients and friends, thank you for joining us for our market update for this month. My name is Alvin and I'm a client advisor at Provident. So to investors that have invested into a globally diversified portfolio, congratulations. You should be sitting on some gains over the past months. So once again, markets have given us two very important lessons. So the first lesson is the importance of diversification. So if Provident, we have adopted an approach whereby let's say we see that growth is doing well, so let's move our portfolios into growth and larger size companies, we would have missed out the returns that Choon Siong has shared earlier that value and smaller size companies has given us. So that's why that it is important to be diversified in our portfolios. So let me just share with you this very interesting study. Let's say if we are invested into a globally diversified portfolio, whether is it in developed market or emerging market. If you're invested into a portfolio that has exposure to both of this, from between a period of 1994 to 2021, on average, our return would have been about 8.5% per year. Okay, so but let's say if we subscribe to the way of doing a tactical allocation, that means we just choose to invest in a few companies that we think will do well. But unfortunately, we missed out the top 10 performers of each year. You will realize that our return actually dropped from an annual return of about 8.5%, it drops to only 4%. And very surprisingly, if let's say we were to miss out the top 25% of performance on a yearly basis, you realize something. Our return drops from 8.5% to actually a negative 4.4%. So what that tells us is that it's very important that we remain diversified in our portfolio so that we can capture the returns from the markets. Okay, so what this study tells us is that only a few handful of companies are responsible for driving the markets. Okay, so but the problem is that research has shown that there's no reliable way to consistently and reliably try to guess which companies are going to be the one that will be the top performers of each year. Okay, so for Provident, what we do instead is we spread our net wide enough to capture this top performance so that when the upside comes, we are able to capture these returns as well. So diversification, it doesn't just manage risk for us. Number two is also about us being able to spread the net wide enough to be able to capture returns from the handful of companies that will drive the returns for the market on a yearly basis. So this is on the importance of diversification. So what is the second lesson? The second lesson is that time in the market is more important than trying to time the market. So what's the difference between these two? Time in the market is basically just means being invested over the long period of time or invested over the long term. Timing the market is trying to go in and out of the market, trying to spot inefficiency and hopefully be able to capture a potentially higher return. That means usually what we call it is you try to sell at a high and you buy at a low. So by this approach, you have to do it consistently in order to be able to capture that return for you. It's really a very hard thing to do. Okay, so I want to introduce to you this index called the Russell 3000 Index. So Russell 3000 Index comprises of the 3,000 largest companies in the USA, and it represents close to about 95% of the investable US market. Okay, so let's say if you have invested into this Russell 3000 at the start of 1998, our $1,000 would have grown to about $6,356 by the end of 2022. But let's say if we go towards the approach of trying to time the market. So we try to time the market and we just miss 1 week. Okay, the best week of return from between 1998 to 2022, you realize that our return, instead of getting $6,003, our $1,000 would have grown to about $5,003, difference of about $1,000. If you miss the best 1 month, it will be about 5,076. And let's say we try to do this timing of the market, and let's say things just become very busy on your end, and maybe whether be it family commitment or work commitment, and you have no time to monitor the market. And because of that, you actually are out of the market and you miss the best 3 months of return from the market, or the best 6 months of the market, you realize that your return, actually instead of getting that 6,003, it drops to only about $4,000 of return. So what this tells us that time in the market is more important than trying to time the market. Okay, so with that, I've come to the end of our video. Thank you for staying through the video. As usual, if you have any questions, please feel free to approach your client advisor. Thank you for your time, and I wish you a pleasant rest of the day ahead.